In this video, let's talk about whether Macquarie Group is a great ASX bank stock for dividend investors, whether there is a stock market crash part 2, and
what happened to my portfolio after the market has pulled back 5%.
What is up everyone, it's David here. After releasing this video on ASX bank stocks, the sheer amount of comments and DMs I got to cover Macquarie was so overwhelming that I decided
to throw away what I have planned for the weekend.
Now, I originally planned to do a video on Zip Money. So if that's something that you still want to see, make sure you gently smash that like button. And if this video gets 500 likes, then I know there is enough demand to create a full video on that. Now, without further ado, let's go. Now, similar to my previous ASX bank stock video, as a dividend investor, I'm really looking for 4 things for a great bank stock. 1, I want the efficiency ratio for the bank to be as low as it possibly can be, because that demonstrates their discipline in managing their operating expenses. And 2, I want to know whether during a turbulent environment, can they still deliver a great return on equity. 3, because I'm a dividend investor, I want to know whether they're growing their dividends year on year and whether that is exceeding the inflation. Otherwise, inflation will just eat away all my dividend growth. 4th is an economic moat. Are they building on their competitive advantage to sustain their earnings over the long run? Now, before we move forward, it's important we talk about how Macquarie Group makes money. They are very different to our big 4 banks, and they are considered to be an investment bank. 77% of their income is made in asset management, commodities and global markets, and capital advisory. So asset management could be helping government or companies finance infrastructure projects like bridges, gold mines, or even electricity networks in different countries. Commodities market lending is more helping companies with lending and loans to purchase metals or even energy. And capital advisory could be mergers and acquisitions or helping companies to IPO. So let's start off with the efficiency ratio. I want to remind you that with the efficiency ratio, the lower the better, because that shows the bank's discipline in managing their expenses as a percentage of their revenue. On the 30th of June 2019,
their efficiency
ratio is 69.68%, meaning operating expenses will consume 69.68% of their total revenue. Over the last 12 years, Macquarie Group have improved their efficiency ratio by 0.4%. Definitely one of the rare few banks who are disciplined enough to do that. Okay, so let's talk about return on equity. In the 2019 financial year, their return on equity was on 16.24%. And over a span of 12 years, their return on equity have actually declined by 1.5%. So if you take 12 years worth of return on equity metrics and plot them onto a graph, this is what it will look like. It definitely seems like before the pandemic, Macquarie Group was on track to go back to its glory days of 17 to 19% return on equity. Now, similar to the other banks, Macquarie Group went on a hunting spree during the GFC, and in 2009, they first bought Canada's Tristorn Capital Global for $116 million, and then 3 additional acquisitions in August, September, and then October. Now, because of those acquisitions, financing those deals would have taken a toll on Macquarie Group's return on equity during 2009 and then the subsequent years. As you can see on the screen, during the GFC, their decline in return on equity is approximately 31.57%, which is quite high even amongst the big 4 banks. Okay, but what about their dividend growth history? From 2007 to 2019 financial year, they grew their dividends by 12.71%, and inflation during this period is 2.3%.
That's massive, by the way.
And not only that, they're only paying out 54% of their earnings, which means that moving forward into the future, there's a lot more room to move when it comes to the payout ratio. Now, there's a couple of things I want to make note of before I move on and talk about Macquarie Group's economic moat. In their newest half-yearly report, their asset under management has went up to $607 billion and went up 10% even during the pandemic. And on top of that, 60% of Macquarie Group's revenue is actually earned outside of Australia, and it's diversified into multiple countries. Now, just keep those notes in mind as I talk about the economic moat and compare Macquarie to other banks. Now, when it comes to the economic moat, this part is very biased, so take this with a grain of salt. Now, if you look at the 4 business groups in Macquarie Group, especially asset management, global markets and commodity, and also Macquarie Capital, they're all incredibly interconnected. From advising infrastructure acquisitions to financing those deals, they can all be done with minimal external interference. That means they can dominate a big chunk of the deal cycle, minimizing the leakage of revenue to external parties because they don't need that help. Now, if we compare the big four banks to Macquarie Group, even though they're completely different things, they are one of the rare few who are disciplined enough to improve their efficiency ratio. Yes, they did have a bit of a tough time during the GFC with their decline on return on equity, but over a 12-year period from 2007 to 2019, you can see that Macquarie, amongst the five, actually have the lowest decline in return on equity. Not to mention, their common equity tier 1 capital is at 12.2, meaning that for every $100 lent out, there is $12.20 worth of equity in their books. That is incredibly strong to withstand any unexpected shocks that might happen sometime in the future. Now, while the other banks over the last 5 years have experienced negative earnings growth, Macquarie Group got a double-digit earnings growth at 11.6% over the last 5 years. So the improvement in efficiency ratio, the lowest decline in historical return on equity over the last 12 years, and a double-digit earnings growth over the last 5 years, yeah, I think Macquarie Group is worth any dividend investor's attention. And on that note, for transparency's sake, yes, I do own Macquarie Group in Argo. So let's talk about some market news and a portfolio update before I wrap up the video. The last couple of days, a lot has happened, and before I give you a quick update on my dividend investing portfolio, I want to talk about some market news and also some of the questions that you have sent me either personally via emails, comments, or even in my Discord server. Now, on the 10th of June 2020, the Federal Reserve essentially came out and said that they're a little bit more on the pessimistic side when it comes to the economy recovery. And adding to that comment, they mentioned that they're going to try and keep interest rate near zero as for the foreseeable future. 2 days after that, the ASX 200 essentially pulled back by about 4.8%. Since then, a few of you have asked me whether the stock market will crash like how we did in Feb and March, and also why is there such a massive disconnect when it comes to stock market prices and unemployment rate. Personally speaking, on the stock market crash point, I have no idea, and no one really knows whether the markets are going to go up, down, or even sideways. And I don't plan to learn how to time the market moving forward into the future. I just think my time is more productive creating videos for you. Now, on the point of stock market prices being disconnected to the general macroeconomic trends, fundamentally speaking, stocks are not what's happening right now. They're meant to be predictors of the future, and they're meant to be forward-looking. Even as a predictor, sometimes the stock market is a good predictor and sometimes it's just not. Here's what Warren Buffett have to say after the flash crash of 1962. I want to point out that in December 1961 to June 1962, the S&P 500 lost 22% of its value. And this is what he had to say.
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally. For example, the last 4 or 5 years, the stock market has been booming along and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher or thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
So yes, the markets can be a good predictor sometimes, and sometimes it's not. But what you really need to remember is just that after the flash crash, which is right here, there was a 7-year bull run that returned 42%. So these things, they come and then they go. And I'm just a strong believer that no matter what happens, eventually we'll recover. And frankly, I have no idea how long it's going to take to recover from this pandemic. But I do want to build on the point of the disconnect between stock market prices and general macroeconomic trends. Market prices are tend to tie to earnings and not real growth in the economy or unemployment rate. So sometimes even when unemployment goes up, as long as the earnings are uninterrupted, the share price will keep going up. Yes, I understand. Wouldn't unemployment rate stop people from spending? Yes, certainly in some areas, but as you can see in our stock market, not all businesses are affected the same way. And on top of that, given how widely accessible credit and buy now, pay later type services are nowadays, people aren't paying with today's dollars, but they're paying with dollars from 2 weeks, 3 weeks, 4 weeks from now. So in light of not knowing the market, whether it's going to go up, down, or sideways, here's what I plan to do to weather through the storm. First, I'm not going to invest any money that I need. I think that's pretty obvious, but for my own sanity's sake, I'm just going to put it out there again. Over the last couple months, I've also added some extra cash into my emergency fund just in case something happens. Third, I'm not going to try and time the market. I don't plan to learn how to do that. I have other things I'm more interested in, and I think my time is more productive creating videos for you. Fourth, I'm going to continue executing my investing strategy by dollar averaging into my portfolio. Now, if you've been watching my previous Sunday videos, then you know that I've done a lot of research for majority of the companies that I hold, and I plan to hold them for the rest of my life, honestly. I don't plan to trade my stocks. I don't plan to buy and sell them over the short term. I plan to, once I buy them, I'm going to hold them over the long term. So I'm just going to keep dollar averaging, and actually I'll try to add a little bit more here as much as I can, because these prices are probably going to be once or twice my lifetime. And the final thing is finding new ways to diversify my income stream. Now, this is important to me because honestly, we have no idea what's going to happen in the future. And if you've been watching my past few videos, then you would have noticed that there have been ads placed on them. And that means I am officially monetized on YouTube, and YouTube has become one of my new income streams. Now, if you want to know what my first YouTube paycheck is, I'm going to leave a comment in the comment section below. Just make sure you upvote it if you want to see a full video on how much I make on YouTube creating videos for you. Okay, so this is my Australian dividend growth investing portfolio. So as of recording this video, the portfolio is worth approximately $49,629. And after the ASX pulled back by 4.8%, my total returns went from 7%-ish to about 3.78. I have to be really honest with you that I don't get really worked up from the week to week or even the day-to-day fluctuations of share price or total returns. Because I'm a long-term investor, and because of the sheer amount of research I've done on all of these companies, I plan to hold them for the rest of my life. Same with the Australian stocks and my US stocks that I'm going to show you in just a second. So it doesn't really bother me that much that market prices went down and market prices went up. It happens almost like every second day. So at the end of the day, as long as I keep dollar averaging into my portfolio and my expected dividends and my income stream is going up, I'm pretty content with that. And I think the most important thing is that I've done enough research to feel comfortable with all of these companies that I own, and I can sleep at night. So that's really, really important to me. Now let's take a look at the US dividend growth investing portfolio. The usual suspects have definitely benefited from that. Apple, Prologis, Realty Income, Microsoft. These tech companies have definitely benefited from this pandemic, whether the times are good or bad. The banks in the US is also making a little bit of a comeback. But again, I don't really take a look at the prices that often. But I do plan to add to my portfolio. And I promise you in the next video on Sunday, I'll show you what I bought. I haven't invested the June portion of my capital because the money's in transit. Hopefully next week I would have finished investing my June portion. Now all of these are dividend stocks except for Dropbox, GoPro, and Nike. And Nike actually is still a dividend growth stock, and I just really like the brand, but these are free stocks that was given to me whenever any of you use the link in the description box below to sign up to Stake. On that note, I'm not sponsored by Stake. I frankly just use Stake because it's affordable and it's easy for me to do majority of my US equities trading with them. So if you want to try Stake for yourself and wouldn't mind getting a Dropbox, GoPro, or Nike, I'll leave a link in the description box below. And that's essentially it for this video. So if you enjoyed that video, make sure you gently smash that like button because that will help out the channel out a lot. And yes, a lot of you have asked me to cover Bobs, and you asked and I shall deliver in next week's video. So make sure you subscribe, click onto the bell, so when that video is live, you be the first one to know. And until next time, my name is David. Otto will always do the honors to see you very, very soon.